7D, right? So you got all got my that might get, and I heard the consternation about that question when Zach and Bernardo and who were going over the quiz, and I realized that there's no answer to that question, and these guys were stumped too. So we did crash test the test before we gave it, but anyway, I accept full responsibility, and so everybody gets 2 points for that question. Yeah, so I don't want to any more past time on that. Please don't be shy about putting stuff in the forum. And we had 66 people taking a quiz. Mean 66 people as of that point trying to take the course for credit. I mean, 61 seats here. And we have, I don't know, a dozen or so people wanting to do it as a listener, but obviously not everybody comes every day, and some people are bailing out, I'm sure. So it's looking like we're really going to be fine in terms of being able to accommodate everybody. So I want to ask, because we're really getting into the nitty-gritty here, roll up the sleeves if you have the sleeves. We're really getting into the nitty-gritty of crunching the numbers on evaluating real estate investments at the micro level of individual properties. And I know that this can get pretty intense, especially for people that don't have any finance background or not much, and who aren't familiar very much with Excel. And what I have often done in the past is offered an extra question and answer session. It's not really a recitation, it's not a tutorial, it's just a Q&A session. We can do it from 5:30 to 6:30, I think is the time slot we have. From 5:30 to 7, we have a room reserved right upstairs from here, where I can plug in a laptop onto a screen, an overhead screen, and anybody is invited. It will be primarily intended for people that are really the neophytes, we call you the poets. But anybody's welcome to attend, but we'll give first priority to questions that are coming from people with no finance background and really want to get into the very basics of Excel. And this, of course, is just supplementing the regular recitations, and also you guys have office hours as well. So we're providing a lot of extracurricular opportunities for you guys, as well as there's always the forum. Let me just take a quick show of hands. How many people would be interested and think you might fairly regularly attend a Q&A session after a class on Mondays like this? Okay, it's enough to do it for sure. Okay, great. Well, we can even start today. I'm available after class today. I will find out, or somebody, do you know the exact room number?
No, the fourth floor one, right?
It's on the fourth floor, yeah.
Right above this one.
Yeah, Tricia knows the room number. It's right up above here. Yeah.
We have a Siri has a speaker series.
That's right, you do, I know. But then again, you guys also are coming in here probably with more background than a lot of the poets. You guys are mostly not poets, but yeah. And then the other thing to keep in mind is, well, let me ask how many people in here now are listeners, taking the course for listening? Okay, so you guys are waiting and you're seeing that there's enough seats. And it looks like this is probably going to be from now on out, I would guess. So, well, we do have some cohorts coming in here. So, I think, maybe there's enough seats for you guys. All right, so I apologize for missing the last 2 classes. I wouldn't have done it except for I had no control over it, and it was something really important that I couldn't miss. And but the result is that I am a bit behind. I know that, and the troika of intrepid TAs did an awesome job last week, but I feel that I need to go back and cover some of that ground that they covered, and also try to catch up, because as you know, I was even behind going into that. As a result, today is going to be a little bit different than it usually is. I'm going to try to cover, a lot of these slides should look familiar to you, a little bit. All right, 87. Fine. So I'm gonna really fly through some of this, but there's always the forum, there's always recitation, so on and so forth. I just can't totally skip or leave out this stuff, but I can't like drag the course out because there's other stuff we have to get to as well. So the plan of attack for today is a little bit of background about institutional investment in real estate. That's the upper tier. That's the larger properties, multi-million-dollar properties. It's really our main focus at MIT. There's the mom and pop investment that many of you may dabble in on the side as a vocation. You may get started at the mom and pop level. But where you're going to end up if you're going to really be in the big time is at the what we call the institutional investment level. And I just want to give a little background on that. And it does very much dovetails with the case that we're dealing with in this module. And then I want to cover what was originally supposed to be in the September 24th lecture that I never even got to. And the TA team tried to cover this, and they did to some extent last week. And then the new topic for today is IRR performance attribution. Hopefully you pounded your head against that a little bit in the homework for today. And then at the very end, I will actually zero in on the IBET performance attribution. So just to step back a minute and orient ourselves, we are moving now into Module 2. Module 1 was, remember, this is the overall system that we're dealing with. The three major elements: the space market, the asset market, and the development industry. And in Module 1, we were really dealing with the space market and the development industry primarily. We introduced some of the terminology and tools from asset market in terms of cap rates and valuing properties in a simplistic way, but we were really focusing on the space market. That's why the urban economics that we did was really about how to understand supply and demand in the space market, and also land values, which are relevant to the development industry, and then how the development industry sort of does its thing at an introductory level anyway. So this was, Module 1 was dealing primarily in this area of the system, and now we're turning to this area of the system. And the asset market is going to be our major focus for the rest of the semester. And so in terms of disciplines, we're kind of moving from urban economics into financial economics. Okay, so it kind of, the flavor of it changes a lot. And maybe the most fundamental question when we're here, because the asset market, the real property asset market, in particular at the institutional investment level, is really a branch of the broader capital markets. And the capital markets are markets that trade capital assets of all types. Real estate is one type. So let's step back and just think a little bit about very basic points of this arena that we're dealing with here. And then maybe the primal question of it all is, why do people invest their money? And the point here is that there's all sorts of different reasons. A lot of it can have to do with, sort of how much extra money you have and how sort of secure you feel like you're always going to, you don't need that money right away, And a lot of it may have to do with where you are in your life cycle, But the point is, there's all different individuals with all different, also people have different preferences in terms of risk aversion. Some people really like to go for it, and they're willing to have some risk in order to get a higher return. Other people really want to be conservative, and they don't want to lose sleep at night, and they're willing to give up return just to be safer with their money. So it has to do with personality really, and taste, but it also has to do with where you are in your life cycle. Also has to do with how much money you have, and so on and so forth. So it's all this variety. And also, a lot of these investment decisions at this level are actually not made directly by individuals, but they're made by institutions that are acting really on behalf, ultimately, of individuals, right? So, insurance companies, they're making the decisions about how to invest the money that their policyholders are giving them. Ultimately, it's for the policyholders, or at least in some sense, but it's the people in the insurance companies that are actually making the decisions, and so on and so forth. But these institutions also, they have different objectives, they have different constraints, they operate under different regulatory environments, they have different asset liability matches and different maturities on their liabilities that they have to match and so forth. So, and they also have different degrees of risk aversion. And so whether it's institutions making the decisions, in some sense using about other people's money, individuals making the decisions in these institutions, it's not their personal money, right? Or it's the individuals directly. Either way, there's a great heterogeneity, variety in investors' objectives. And this result is you have different time horizons, different risk tolerances, different needs for income versus growth, which means that there's a lot of opportunities to create investment products that are tailored to these different objectives and different constraints and so forth. And that's a lot of what the investment industry is about, is creating investment products. You've got sort of the underlying raw material, which is the physical capital assets that are generating benefits for society and thereby generating cash flows for their owners. But on top of those physical assets, using those cash flows, you can create a variety of different investment products that serve all these different niches in the investment marketplace. That's a lot of what goes on. But in a very big picture level, a very deep level, there are two major different investment objectives. And to some extent, these are sort of mutually exclusive. It's a trade-off. But for the same sort of raw material, you can get more growth only by having less income, or more income only by having less growth. So these are the two basic objectives. Growth means that you're looking for a long-term horizon. You don't need to take money out of that investment in the near term. Income means that you need money from that investment right away and on an ongoing basis. And you can see how different types of investors would have relatively more need or desire for one or the other of these things. Now, if you're in the stock market, you can very easily convert from one to the other, because basically you get growth from the growth in the stock price, right? You've invested, you've bought a stock, and if the price of that stock rises, you've got growth in the value of your investment, right? But you haven't taken the money out. It's still in there. So just because the stock price rises, you don't get that unless you sell the stock, right? So, but then also the stock pays dividends, right? So you're getting, if it does pay dividends, not all stocks do, but if it's paying dividends, then you're getting income on an ongoing basis. Now, let's say you want more income and you don't need so much growth. And in the stock market, it's very easy to handle that. What would you do? So your stock has gone up in price. You've got more growth than you need. You'd like to have some more income. What do you do?
Change stock.
Yeah, just sell some of the stock. Very easy to sell a little bit of your stock holdings. You can sell however many shares you want, still have the rest of them in there. Very little transaction costs. You can sell quickly. So you just simply convert growth to income by selling some stocks. And suppose it's the other way around. Suppose you wanted more income than, I'm sorry, suppose you wanted more growth. So the stock didn't rise much in price. You wanted more growth. You didn't need all the income it was paying out. So you can convert the other way, convert income into growth by doing what?
Reinvest your income.
Yeah, just what we're saying is you don't need all that income. So you take some of that income, whatever it is that you don't need and want to turn into growth, and buy more of the stock with it. So easy to do that in the stock market. But what about with direct real estate investment? Now, there's indirect ways of investing in real estate that might make this more easy, especially like if you buy a REIT stock, then it's just like stocks, right? It is a stock. But if you're investing directly in real estate, where you're owning the private property, assets themselves, how are you going to do that? The conversion is more difficult, right? It's going to be more expensive. One thing you can do, if your property has grown in value, and you don't need that much growth in value, you'd like to get more income out. One thing people do, it's very common, is they'll do what do you call a cash out mortgage. They will borrow, since maybe initially maybe the property was $100 and you borrowed $75, and now the property's worth $200. I don't know. Now the property's worth $200. You still owe $75 on it. You could easily take out now a bigger mortgage, on it, maybe even a $150 mortgage, and use that mortgage to pay off the $75 mortgage, and now you've got $75 of cash from that second mortgage. It's not from the mortgage that replaced the previous mortgage, right? So, and you just have the same amount of leverage that you originally started with anyway. So that's one thing you can do, but that's, you have increased the leverage compared to if you didn't do that. Right? So you change the nature of your investment. And even then you haven't, totally converted. So anyway, there's things you can do, but it's more awkward and more expensive, more time consuming to convert. So real estate investors do care a little bit about this. They care more than stock market investors about, at the underlying asset level, the assets that they're buying, this difference. So we have, in addition to these objectives, you have constraints relating to risk, liquidity, time horizon, management burden. Because when you buy real estate, unlike buying stocks, you buy the control of the entire asset, which means you buy the responsibility to manage it, but also the opportunity to manage it, right? If you're good, if that's one of the things that you're good at, then you can use that as a way to make money, right? So, how much money do you have available to invest? Can you get more money if there's good opportunities, etc. So, so that's a real quick, taking you through a real quick walkthrough of maybe the most fundamental things about the investment industry. Why do people invest? What are their objectives? What are their constraints? And the diversity in that, which that diversity provides opportunities for the industry to make different types of products that serve these different niches. And that's one way that you can sort of create value in the investment industry, is by coming up, say, with a new kind of investment product that serves one of these niches, people will pay for that. So, a famous and huge example of that is CMBS, commercial mortgage-backed securities. This was a new product that was developed in the 1990s, and it dealt with, let's say that the management burden and the requirement for specialized expertise to invest in real estate, and in particular among people who don't want much risk and who want more liquidity, and who have a specified time horizon. Okay, so there's a niche of investors that have a lot of money. I'm describing a pool of investors that is huge. These are investors that have a low risk tolerance. They're really risk averse. They don't want to take on much risk. They want to have a lot of liquidity. They have a specific time horizon. They have liabilities that they need to match exactly in 10 years. So they need an asset that will mature in 10 years exactly. They do not have the ability or desire to manage this investment themselves. They want to be passive. They do not have particular expertise about real estate or about anything except their own business. Right? And how can you get that pool of investors to be able to invest in real estate? Because real estate has some risk, even if you buy good properties. It does not have much liquidity, right? To sell a property, it's going to take time. It's going to be expensive. It doesn't have a specific time horizon. Properties last forever. You do have a major management burden. You got to operate the property. And you really need specialized expertise about the markets that you're investing in, about real estate. So real estate flunks all of these things those people want. But CMBS is a product that was created, and they structured it such that the top tranches, as they say, the top classes of those bonds have all of those characteristics that those people want. They're given enough credit protection that it basically largely eliminates the risk, because the lower class bonds will take all of the losses before the high class bonds do. The bonds are plain vanilla enough that they can sell in the bond market, which gives them a lot of liquidity. They have specific time horizons that are based on, you can structure these things so that as mortgage payments come in, those payments are used to retire bonds in a specific order, which then gives the bonds a specific time horizon. And the people that are managing the properties are the people that have borrowed the money, and they're experts. They know, that's why they bought the properties. So the lenders don't need to worry about that. And furthermore, you don't need to be expert in the real estate market, because we have a friendly bond credit rating agency that has slapped a AAA credit rating on those bonds. You know how reliable that is. It got a bad name in the crash. Yeah, they weren't perfect. They made some mistakes. But basically, big picture, it does work. It's been working for a century, bond credit rating. And there was, I believe I'm correct, of all the hundreds, maybe thousands of senior CMBS bonds that were issued before the crash, I don't think a single one of the most senior classes have experienced actual losses. Am I wrong? Does somebody have better? At most, it's like maybe one issue or two issues out of hundreds of thousands. So now that's just the seniors. Those are called the super dupers, and that's not all the AAA. Some of the AAA stuff has experienced losses, although most of it hasn't. But of the super ones, I don't think a single one has experienced losses. So indeed, these people were able to go in there blindly at the peak of the bubble and still get all their money and all the money that was promised them back. Anyway, I wanted to get too digressed here, but this is the idea of how you can create a product that converts, it's like alchemy, converts one form of asset, one form of investment into another in order to serve different niches. Now, given this, if you look at the underlying pool, all the physical capital that's out there, it can serve as the basis for securities and for investment vehicles. Real estate is a big chunk of the total. This is just one way to slice the pie, but and these numbers are even a bit out of date. But basically, what you're seeing here is there's sort of four major asset classes in terms of types of capital that underlies all of the major investments, institutional investments. And it's basically, stocks, bonds, real estate, and then you could call it cash, which would be the really short-term government instruments. And so real estate is a big chunk of the total. And one of the things that institutional investors need to do is to decide that they have these huge pools or portfolios of money that they need to manage. And they need to decide what's going to be the allocation, how much they're going to put at this broad level to these different asset classes, stocks, bonds, real estate. So real estate is very much in competition with stocks and bonds at this level of institutional investment. And investors are comparing all the time, and they'd like to compare as rigorously as apples to apples as possible, with as much numbers as possible, meaningful numbers, across these asset classes. And over the past generation, a lot of the development of sort of the technology and methodology in this upper level of real estate investment has been to come up with these numbers that enable this kind of comparison across these asset classes. So, but the big picture is that we do have these four asset classes, and none of them duplicates in any of the others. There's unique characteristics. If you look at various dimensions of concern: risk, return, yield, current yield, that means the income component, right? Growth. So these are the two breakouts of the total return. Inflation protection is another dimension that people think about, because you can be getting a great return in nominal dollars, but if inflation is eating that away, then your return in real dollars isn't very good. So all of these asset classes have different sort of characteristics, a different profile along these dimensions of interest, which means that there's scope for investors to invest in all four of these, because unless your preferences are exactly matched by one of these, profiles, then you want to have a blend. Even if your preferences are exactly matched, I would say you still probably want to have a blend just for diversification purposes, because diversification is kind of a free lunch. It lets you reduce the volatility of your portfolio without reducing its expected return, or put another way, it lets you increase your expected return while not increasing your volatility. It's what diversification does. And at the broadest level, and diversification works most effectively at the broadest level between these asset classes. You drill down within any one asset class, and you can still get diversification within an asset class, from the individual assets that you invest in, but not as much. There's going to be more diversification across asset classes than within an asset class. So this is the basic argument for why there should be what you call multi-asset portfolios, mixed asset portfolios that blend stocks, bonds, and real estate, and maybe some other kind of alternative investments. And that's a lot of what is driving pension fund investment policy. And the IBET case talks about that some, right? I told you about ERISA, the law that was passed in 1974. They really told pension funds, you should really think about diversifying. And you have the blessing of the government to say that you can diversify, or even you should diversify. So, and that really instigated a lot of institutional investment into real estate. And that was, a generation ago or two. So, we can look at these long-term histories of these asset classes from 1969 until now. If you put $1 at the end of 1969 into each of these four asset classes, how many dollars would you have if you reinvested the income by the end of 2010, over 41 years? And you can see that over the long run, the assets that are more risky, the asset classes that are more risky, as evidenced by the ups and downs, do tend to provide a greater return. Stocks are the most risky, and they end you up with the most money, even after the big crash. But real estate is really fighting in there with a close second. But it also has its big ups and downs. And of course, at the bottom here, the CPI, that's the consumer price index. So you would need that many dollars just to give you the same purchasing power of $1 in 1969. So in order just to preserve your money in real terms, in purchasing power terms, you'd need that amount of growth, the solid black line here. So all of these, including even T-bills, provided that, but T-bills just barely. This is apples and oranges, right? I mean, how can you say, so $5.80 today buys me the equivalent of what $1 bought me in 1969? I was around in 1969. It was a different world. I mean, there was so many products that we use today that are like a part of our everyday life that we couldn't imagine living without, didn't exist back then. But so how can you possibly, compare $1 now to $1 then? But in any case, statisticians think they can do that somehow. But here's another picture of the four asset classes. This is in terms of their long run average return per year, and how much of that return is income versus growth. And what you see is that, yes, stocks have provided, on average, the most return, and real estate and bonds are kind of intermediate, and cash is going to give you the least return. And inflation is, just to beat inflation, you need to beat that hurdle there. And notice that stocks provide most of their return in the form of growth, and real estate, most of it in terms of income, but not so much. Bonds is even more an income play. In general, in principle, bonds should be totally income and no growth at all. The reason why there's a little bit of growth here is because interest rates have been on a big secular decline over this 40-year period, and mostly because inflation has been on a big secular decline. And you know what secular means, right? It doesn't have anything to do with religion. It means it's a long-term trend. And so when interest rates go down, bonds that have fixed interest rates, their value goes up, right? Because you're getting the same cash flow from the bond, but the discount rate is going down, so the present value is going up. So that tends to raise the prices of bonds, which means you're getting some capital gain in a typical long-term bond investment. over this historical period, looking back here, probably won't be the case the next 40 years, right? I don't think interest rates can go any lower than they are. So you can forget about this part of the bond returns in the future. And real estate, remember, what we're looking at here is the underlying asset, the physical capital, the property. We're not talking about a levered equity investment here. And in the next module, in module 3, you'll see what leverage can do and how we can use borrowing of money to change the nature of this return and make more of it in the form of growth and less in the form of income, and increase the total amount of it by increasing the volatility. But that's for next module. For now, we're looking, this module, we're totally about the property asset itself, the underlying bricks and mortar. We're not considering any debt. We're not worrying about mortgages. That's for next module. Okay, we got to take this one step at a time. You can see it's complicated enough as it is. So, so these are the 4 asset classes in terms of the nature of their returns. Here's the risk, the volatility. This is the annual volatility over that same period of time. And clearly stocks are more volatile. Real estate and bonds are about the same. T-bills are your safest investment. And of course, the correlation between this bar chart of risk and this bar chart of return is no coincidence, right? Risk and return. You get more return for higher risk. You have to take on more risk for more return. And there's a little bit of apples and oranges here, maybe more than a little bit. Bonds seem to be very volatile. These are long-term bonds. And like I say, when interest rates go up, the present value goes down. When interest rates go down, the present value goes up. Interest rates are quite volatile. Therefore, bond value, long-term bond values are quite volatile, and that's causing this volatility. But if you are a bond investor, like those people I was talking about a minute ago that wanted the AAA CMBS bonds, you buy your bond probably for some purpose, namely you want that cash flow for a specific time horizon. And so let's say interest rates go up and the value of your bond goes down. What are you going to do? Keep it. Do nothing. You bought it to hold it and get that cash flow, right? And when its maturity comes, it'll pay off the face value. So for you, that volatility doesn't matter. It is there statistically, but it doesn't matter for a lot of the investors who are buying bonds, which is one reason why bond prices can be as high as they are and bond returns can be, it's one reason why bond returns can be lower on average than real estate returns, even though its volatility measured this way is higher than real estate volatility. Okay, so that's sort of big picture of the nature of these 4 asset classes. Now let's look at our institutional investors. And there's different kinds of institutions, but a big chunk of them are pension funds. And various types, and it's even, what do you want to define as a pension fund? For example, some of these sovereign wealth funds, from overseas, they're actually related to the pension in that country, the social benefits that country provides, Social Security. But what this is talking about here is just U.S. domestic pension funds as such. And it's a huge amount of money. What is that, like $15 trillion? This was as of 2010. It's more than that by now. It's basically, this is a stock, and a GDP is a flow, so we're kind of comparing apples and oranges there, but it's the size of the US GDP. And the thing about these is these are all sort of managed accounts in some way or another. So you have professional investment professionals making the decisions on how to make these investments. But more, to greater or lesser degrees. The classical, traditional kind of pension fund, which is the kind that the IBET case is called a defined benefit. And there, they take a portion, the company that you work for, or the agency that you work for at MIT, they take a portion of my salary, whether I like it or not, they're going to take a portion of my salary and they're going to put it in this fund. They're going to match it with some of their money too. And in return for that, when I retire, depending on how long I served here, I'll get some fraction of my average salary or something like that. So the amount that the pensioner gets is defined. That's why it's called defined benefit. So the sponsoring entity has to manage the money to provide those benefits. And to the extent they can manage the money to provide more returns, than they need to pay those benefits, that's gravy for, that's extra money they can use. To the extent that they manage it and if they don't have enough, they have a shortfall, that's big trouble. They have to make that up somehow because they're contractually obligated to provide those benefits. So the risk is really borne by the risk and the reward is borne by the sponsoring institution. But these over here, this is the new kind. And really, these guys here, the defined benefits are dinosaurs. They're going out. They're too hard for these entities to manage. And but there's still a huge amount of capital in there, and it's not going away, right? Only as we baby boomers kind of draw all this money down over the next 30 to 50 years, these may sort of whittle away. But for now, these are still major players. But the up-and-coming kind of pension funds are the defined contribution. And there it's more the responsibility of the individual, the pension person. You can decide how much of your salary you want to put into these. However much you put in, you'll get a tax break on. It'll be taken off the top of your taxable income. So you'll save income taxes from that. And whatever you put in there, it'll grow tax-free while it's in there. And then when you take it out, you'll have to pay taxes on it. And you decide sort of how to allocate the investment. But these things are managed, the 401ks, they kind of guide you and direct you, and the opportunities that you have is kind of, you have a menu. You can't just do anything you want. Now these IRA accounts are much more free. The individual really, that's your own money, and it's also tax deductible, but this is not like sponsored by your employer or anything, or not organized through your employer. So you have a lot more freedom how you want to invest that. But there's plenty of mutual funds and investment management companies that will help you decide how to do that. So this is like the big world of the big money. And notice that even if we look just at the defined benefit part, which is kind of the part that's most centrally managed, and you can kind of market to these guys most easily, because over here you have to market to all the millions of individuals who are deciding on their accounts. Here, you only have to market to a few thousand pension funds that exist in the US. And so this is kind of an easier market for people to try to sell to. And even if we just look at that market, and even if we assume they only have a target of 10% in real estate, and remember we said that there's all these 4 asset classes, and 10%, if sort of neutral would be to give them a 25% target, right? It's going to equally weight across the asset classes. But let's say for whatever reasons they want to not put as much in real estate as they do in stocks and bonds. And traditionally, the tradition among these investors was to, actually, if you go back to just after World War II, they were putting almost all their money just in bonds. They were still freaked out. They were still spooked about even the stock market from the great crash of the 20s and 30s. But gradually during the 1950s and 60s, they got comfortable with stocks too. So going into the 1970s, they were basically stocks and bonds, but no real estate. And then because of ERISA and gradually the evolution of the industry, they begin to get comfortable with some other asset classes, including real estate. So let's say they put 10% in real estate. That's over $600 billion. That's a lot of money. And I'll give you an idea. And this is the world in which the IBET case is situated. And if we look here, going beyond the US, globally, $26 trillion. And if they have a 10%, that's my but obviously, if the global target is 10% real estate, that's $2.6 trillion globally. So it wouldn't all come into the US. Basically, if you look at these countries, the way they're allocating between stocks, bonds, cash, and then the other is not just real estate, but real estate is a big part of the gray slices. So the US, for example, 24% into other, and so that's real estate and commodities and hedge funds and various types of what they call alternative assets. So, sorry. If we look at the allocations, so these are public pension plans, this bar here, meaning pension plans of like state government, municipal government, school systems, and so forth. These are corporate pension plans, so these are the defined benefit plans of, IBM and I don't know, whatever corporations still have their defined benefit plans. So the MIT defined benefit pension plan would be in this bar here. And Taft-Hartley, these are union pension plans. So unions also have their own pension plans. And notice these allocations are all pretty similar. The blue is, so this is of their real estate allocations, how are they dividing them among different types of real estate investments? And the blue is what you call core, and the gray here is value added, and the tan is opportunity funds, and the yellow is REITs, and the green is something else. I don't know what that would be. Other includes private mortgages, CMBS, securitized foreign investments, and non-securitized foreign investments. Okay, so the core, at least as of whenever this was, core was kind of dominating among the pension funds. But the growing segment, I'll tell you, has been recently the opportunity funds here, the tan. And now these guys here are a bit different. These are endowment funds, not pension funds. So this would be like the MIT endowment. These operate under a lot less regulations. They can take more risk. And they tend to be more out there in terms of looking for more risk and reward, so they put more into opportunity funds. These we're referring to the different styles of real estate investment, which I will basically, I think Zach showed you this picture. Core investment, core real estate investments, you're gonna invest with very little leverage, so not much mortgages, so you're playing it conservative there. You're going to buy properties that are fully leased up and stabilized, they're operating well. They're going to be solid properties in solid locations, good deep markets, relatively liquid. So relatively little risk and relatively little reward. Value, opportunistic at the other extreme. You may use a lot of debt, a lot of leverage. You may borrow a lot of money, maybe in mortgages, maybe in entity level debt. You may invest in properties that are development projects. You may invest in properties that are, half leased and need a major renovation, major turnaround, with a lot of debt involved. You may buy distressed debt. You may, you're gonna do the more risky things with more leverage and really have a lot more risk, a lot more diversity of outcomes, but on average a higher return. And value added is kind of in between, and there you're using a fair amount of leverage, really varies quite a bit, and you're buying assets that are less solid and well established than the core assets. Although honestly, a lot of times what value added did is they did buy the stabilized asset, but just with a lot more debt. But you might be buying assets that do need some remarketing. They're not going to be major redevelopment is the idea. That's more in the opportunistic category. And then sort of the industry realized, well, there's kind of a gap between these really safe plays here and value added, because value added kept creeping up the spectrum here. And so that opened up a gap. And so people developed these things they called core plus funds, which would use a little more leverage and go for a little properties that were a little more, high risk, high return than the core. So these are the styles of the investment funds. These styles have been really developing over the past generation. At the time of the IBET case in 1999, these were a fairly new kind of way of classifying real estate investment. But the intention of the IBET portfolio would be largely to have been core or maybe core plus a little bit. It's a pension fund, they need to be conservative. They don't really have enough money to take a flyer. on doing something opportunistic, although we did notice of the 8 properties, 6 or 8 properties that were in there, one of them is clearly, what would you, do you remember what property would clearly be in this opportunistic category?
Northwest.
The Dallas land, right? They have a piece of vacant land in downtown Dallas. So, and also what about that hotel, the Empire Hotel in Rochester? So, actually, I'm going to tell you a secret. That case is based on a real case, as Harvard cases usually are. The reality is this Los Angeles County pension fund for the workers of Los Angeles County and LaCerda, Los Angeles County Employee Retirement, somebody knows? Anyway, I believe 3 of the properties that are in the case are ringers. They didn't really exist in the Los Angeles County portfolio, and one of them is the Dallas land, and one of them is the Empire Hotel, and I forget what the third one is. But if those seem like they're a bit, out of place, they are. But that's all part of the learning process. And in the homework for Wednesday, we'll have you guys look at that and tell us some of your thoughts about it. But I mean, to look at all the properties and think about the buy hold, which ones would you keep, which ones would you sell, and why? And that decision is partly a decision based on the individual properties, how they look in terms of, if you like them or not as an individual hold, but also looking at the portfolio as a whole and its balance and its balance relating to the objectives of the pension fund and so forth. So then there's these different vehicles, different ways that pension funds can invest in private real estate. Obviously, they can also invest in REITs. But what IBET is doing is really the type of investment that you have to be a pretty big pension fund to do this. Because what you're doing is you're hiring an investment manager. Well, the biggest pension funds, they do it all on their own. They do it themselves. They develop an internal staff that's has enough capability, enough resources and expertise to go out and working with brokers and joint ventures and whatnot. But they find their own investments and they do it themselves. The most huge pension funds have to do it that way because they're so big they would swamp any of the investment managers. Like I'm talking about the Norway, Norges Bank, the Norway Sovereign Wealth Fund. They want to do 10% in real estate. They have to build up their own internal in-house expertise to do that. Because if they would put 10% of their $1 trillion, $100 billion into real estate, if they put it all in one investment manager, they would totally swamp that investment manager. They might as well buy the investment management firm. If they put it in more than one investment manager, they'd be competing against themselves to bid up the price of properties that they would buy. So that wouldn't make sense. So they have to build up their own internal staff if you're that big, $1 trillion. Right? But down a level from that, what you can do is you're really buying your own properties. They're your properties, but it's being done through an investment manager. And the investment manager is really helping you do that. They're finding the properties for you. They're managing the investments. They're covering some of the liabilities and whatnot in return for fees. And that's what IBET is doing. If you don't want to do that, and if you're too small to do that, because you need to have a certain scale in order for that to make sense, then you go with a fund. And the funds can be open-end or closed-end. And the open-end funds are the ones that allow the smallest investment increments. Maybe you only need $1 million or something to put into an institutional open-end fund. It's called open-end because you can buy in and sell out at any time. Anytime, I put in quotes because you can only do it maybe once a quarter. And only then if there's enough liquidity in the fund for you to do that. And when is there probably not going to be enough liquidity in the fund for them to cash you out? When everybody else wants to cash out. And when is that going to be? When the market's going down. So the time when you really most want to be able to have the liquidity and cash out of your open-end fund, you're not going to be able to do that. So just keep that in mind. But apart from that, it works. And closed-end funds, and it's called commingled because you're pooling the capital from a bunch of different investors and putting them into a bunch of different assets. And it's all pooled, and you can't buy or sell individual assets. So the closed-end funds, they open themselves, they announce a capital target, we're going to raise $1 billion, and they try to get investors to ante up and buy shares in the fund, and they get their $1 billion and they close it, nobody else can come in. And meanwhile, they're trying to invest $1 billion, and so they finally get it all invested. And then gradually over time, they'll sell, first of all, they'll manage these properties, they'll pay out the income to their investors, and over time, they'll sell the properties, hopefully at a profit. And whenever they do, that money will also go out to their investors, and ultimately the fund will be wound down, and there'll be nothing left in it. They will usually announce a target time horizon when they're going to try to sell all the assets by. But they'll allow themselves some wiggle room there if they don't want to have to sell into a down market. So that's closed-end fund. Joint ventures is how you can come in really on a customized deal-by-deal basis with a specific partner that might be more of an operating partner, like a developer. So the pension fund would join directly with the development company to build a real estate project. Okay, so you can see that a lot of the investment is done in the way that IBET's doing it. Here's the record of performance from beginning of the century. And sure enough, the opportunity funds have provided the most total return, but also the most risk, the most volatility. Really depends on when you bought in and when you sold out. The core funds, this is the solid gray line, don't provide as much return, but also not as much risk. The value-added funds, they have been real losers in this particular period of history because they've had more risk and less return. The interesting thing here is that the blue line is what's going on with the properties underneath these funds. You would think the core funds, and the blue line is basically core properties. So you would think the core funds should be able to pretty much mimic the blue line. Because core funds don't have much leverage, and they're buying these kinds of core properties. But of course, they're taking out the fees, the management fees. Yeah.
What is it about value-add funds that's so bad? I mean, is it management fees that are eating away at returns, or what?
Well, I think that's part of it, because they do have higher management fees. But I think it's mostly that they didn't have a real super business model, because what they tended to do was buy really core kinds of real estate with more leverage. But they tended to do that during the big upsurge, and therefore they got really clobbered. They exaggerated their downfall because of the leverage that they used. So it was a case of poor timing of use of leverage, borrowing when prices are high, and then having to delever or sell when prices were low. Now, I don't know, maybe, hopefully these funds will do better going forward, because you guys are going to go out in that job market and work for them, and you're going to do a lot better, right? But anyway, even the opportunistic funds on a risk-adjusted basis, I don't think it's a real record to be real proud of. So let me go now, shift gears into the classical basics of valuing individual assets. And this is discounted cash flow, and it is an awesomely beautiful model. It's really unassailable. Well, it does have one chink in its armor. It does not represent options. Okay, we've talked a little bit about options. It does not evaluate optionality. It does not value flexibility that exists. But for your typical plain vanilla investment where there isn't a whole lot of optionality, discounted cash flow is pretty unassailable in theory, in principle, right? In methodology, you're going to forecast the cash flows, ascertain the required total return, the opportunity cost of capital, what you could otherwise earn from your investment, discount the cash flows at that opportunity cost of capital, and that's the value of your investment. Can't argue with that, right? So in theory, in principle, it's really great, it's beautiful. Of course, express it algebraically. We've got the cash flows in the numerators. We've got the opportunity cost of capital. R, remember, is the total return, because these cash flows are the total return. It includes the income that the properties are generating while you're holding them. And the last period, the capital T here, that includes the reversion of the capital value when you sell the property. So this is both capital and income, return on and return of your investment in the numerators here. And the denominator, the R, the discount rate you're using, is therefore a total return. And if you're using the same discount rate all the way across here, it's a blended return, it's a multi-period return, so it's an IRR kind of return. So that's the way it works. It is important to realize there's sort of these three elements to it. There's the forecasting of the operating cash flows while you're holding the investment. There's the forecasting of the resale value, the salvage value, the terminal value, what the thing is worth at the end of the horizon. And there's the opportunity cost of capital down here in the denominator that you're going to discount. And I have a simple numerical example here, but it's too simple. But what's the, why is this important? First of all, keep in mind it's cash flow based. It doesn't get confused by accounting numbers, which are not real numbers in some sense. Accounting numbers are very important, they're very nice, especially for accountants, but they are not actual cash flow. What really matters, because it's really solid, you can really do stuff with it, is cash. And that's what the DCF, that's why they call it, that's the CF part of the DCF. Okay? It also takes a long-term perspective, which is appropriate because that's the reality that we're dealing with, especially with real estate investments. Real estate investments at the direct private property level are long-term. And typically, the typical investment is held 5 to 10 years. Some of them are held a lot longer than that. And the typical sort of pro forma horizon that people mostly use is 10 years to do these analyses. It takes a total return perspective, as I mentioned, because the numerator and the denominator here reflects a total return. Numerator is the total return in terms of all the different kinds of cash flow that you can get, including the repayment of the asset itself. And the denominator is the total return that you could get from an alternative investment. It's your opportunity cost of capital, is what you're giving up in terms of expected total return when you put your money in this asset. So now, because of these things, just going through the exercise, think of a DCF analysis as an exercise, right? It's like what you do, your calisthenics to keep yourself healthy. If you take it seriously, it can be very good, including it can help protect you against a bubble. Because if you do this seriously, it will reveal that something's out of whack when you're in the bubble territory. It will, if you do it seriously, it will reveal, for example, in particular, that the realistic expected return you're looking at here is very low, and maybe far lower than would be warranted by the amount of risk. So that would be a big red flag that we don't want to invest now. Unfortunately, what sometimes happens in the case of bubbles, and in particular what happened in the middle of the last decade, is that was true there was no alternative investment that wasn't giving you that same kind of result. All of the asset classes were bubbled up at the same time. Stocks were overvalued, bonds were overvalued, real estate was overvalued. And so it's like you would look there and you would say, if you were being honest and realistic, hardly anybody was, but if you were seeing that, oh, these R's are like really small. If I'm being realistic about the cash flows here, and if I get the value, if I plug the value here as the market value, what I have to pay to get this asset, then the only way to solve the equation is to have an R that's really low. So I don't want to make the investment, except I've got all this money, I've got to do something with the money. Don't really want to put it into treasuries because they're like yielding very little. So So I look for some other investment to put my money in, and they're all giving this same kind of result, if I'm being realistic and honest. And so people were kind of stuck. But that doesn't always happen. Sometimes one asset class or one segment will bubble up and the others aren't. And then you can, if you're serious about this, use this as a way to flag the assets that you don't want compared to other assets that you do want. So we'll particularly see an example of that in module 3 when we look at the Angus Cartwright case. Yeah.
How do you define being serious about it? I mean, is it just?
Being honest about, I'll get to that in a minute. Okay. So, yeah, I'm going to skip through some of this really basic stuff. This is a kind of a fine point that is actually, it's really important because it's fundamental, but I'm not going to skip it. I'm going to quickly make the point here. Let's suppose you've got a property and it's got an existing lease. So, and its cash flows are coming from a single space, and it's right now the space is fully leased out. It's going to pay $1 million a year for 3 years, and then $1.5 million for the 3 years after that. So you've got 6 years of contractual cash flows. It's like a bond for 6 years, unless the tenant defaults, which let's say is pretty unlikely because they're a pretty good company. They're not going to default. If they default on their lease, they're going to lose their space. Anyway, then you get it back and you can lease it out. So, this is a pretty safe cash flow here. So therefore, remember, discount rate is related to the risk-free rate plus a risk premium. So we're going to discount those cash flows at a pretty low discount rate, let's say 7%. And that would logically be very reflective of the rate at which that tenant can borrow money. Because this is contractual cash flows, just like if a tenant borrows money, they contractually owe money to the bank. And the bank is willing to lend them money at 7%. The bank has enough confidence in this tenant that their risk is low enough to make contractual payments that they'll lend them at 7%. That's a good indication that's the opportunity cost of capital for the cash flows, for those cash flows. They have that amount of risk. So we discount those cash flows at the 7%. Now, beyond that, the property still exists. Beyond the end of that lease in 6 years, the property's still there. You still own it. You're going to release it. You're going to lease it out again. And let's say by that time in the future, you figure you can probably lease it for $2 million. We'll cut off our analysis at 10 years. Maybe then we sell the property. And so, when you made that second lease, you're going to be getting what you expect to be, what you're now, as of time 0, projecting will be out there in year 7 and beyond, $2 million a year from that subsequent lease. And so once it's signed, that lease also will be of similar risk, you could presume, to this one here. So you would discount it also at 7%. Back to the time when that lease begins, when it's been signed, which is 6 years in the future. Okay, so we're only going to discount 4 of those years, and it's year 7, 8, 9, and 10. We're discounting them back to year 6. But then the present value of that future lease today, we're going to discount that back the other 6 years from year 6 all the way back to now. We're going to use a higher discount rate because this lease doesn't exist yet. You're estimating, your best guess, the expectation is you can lease it out at $2 million, but that might be wrong. And so there's risk on that $2 million, unlike the risk that's here in this lease that's already signed, where you already know the 1 and the 1.5 million. So while this first lease, because it already exists, it's already a signed contract, you can purely discount it at the 7%. The second lease, you discount it at 7% within the time frame of that lease, because once it's signed, it will be of that low risk. But between now and when that lease will exist and be signed, it's more risky and you have to discount it at a higher discount rate. Meanwhile, you're going to close out your analysis by assuming that you'd sell your building at 10 times the then current cash flow 10 years from now. That's a risky number because, for one thing, you don't know the $2 million for sure, and for another thing, you don't know the cap rate that the market would indeed value that at 10 times multiple. So So we're going to use the risky discount rate here. The point is there's sort of two different opportunity costs of capital that typically apply within a commercial property that has long-term leases. There's the intra-lease opportunity cost of capital and the inter-lease opportunity cost of capital. And they're not the same. The inter-lease opportunity cost of capital is higher. And if you really do a present value properly, you would reflect that. But in the real world, nobody does that. They just blend it all together in a single discount rate. But keep in mind that that's what's going on. And sometimes you can find opportunities where properties get mispriced because of this shortcut that typically happens in the real world, where people will observe the typical blended going in IRR and they will just apply that to a property, even though that property has a lot more contractual cash flows than the typical property from which they're getting this discount rate. And there's a numerical example of that in the book I won't get into right now. But in the real world, where people do apply two different discount rates is in the really obvious cases where you have, say, a single tenant building with a long-term lease, and that's like a bond, and you'll evaluate that lease using one discount rate, and you'll evaluate the sort of the residual cash flows or the other cash flows using another discount rate. People do that, but that's only in the kind of extremely obvious cases. There are cases that are more subtle where you could maybe do this and find some bargains. But we will get into this more in module 4. Yeah.
Yeah, I was going to ask in practice when you're trying to model that or trying to come up with a rate that would be trying to encompass the risk of if that tenant left. Is that the type of thing where you call the bank or you try and get some sort of quote on it, or?
You mean for the interlease
Yeah,
rate?
exactly.
No, there's ways to try to figure out the interlease rate. It's typically going to be 100 to 200 basis points above the intralease rate. But this is actually discussed a bit in the book. There's actually an appendix that gives you a way to back it out. But the appendix is on the CD. And we will talk more about that as the course progresses. There are some classical mistakes. So I've been telling, this DCF is a beautiful model, right? It really is an elegant model. It's very solid, except for the business about options. The problem is, in the real world, it is very widely used, but very widely abused. People they don't take it seriously. They really put the emphasis on the pro forma part of the label. In fact, it's typically called a pro forma rather than a DCF. Pro forma means for the form of it, for the formality of it. It's like something you have to do, just because you have to do it, not because you really want to do it, and so, or really care about it. And so, that's not what it sort of officially means, but it's can mean that, and it really does mean that. So I think it's kind of a missed opportunity out there in the real world that people should take this more seriously and really try to make the numbers be based on reality. This includes several kinds of mistakes I'll get into more in a minute. But another thing that people typically don't do very well with this is to pay attention to the cycle. So let me get into these a little bit more. In terms of the mistakes, the things that sort of reflect the whatever it is, the laziness or the system, there's three major things. And the beauty of these mistakes is they cancel each other out so that you can do these mistakes and fly under the radar and nobody realizes that they're mistakes. So you make the rent and income growth assumption too high, higher than is realistic. And you make the capital improvement expenditure or they don't really usually do that, but you make the capital improvement expenditures prediction too low. So that's going to give you, if you use the right discount rate, that would give you too high of a present value. But then it would be obvious that you're making a mistake. Because remember, these assets trade in well-functioning markets. We can observe the market values of these assets pretty well. And if you get a present value that's above the market value, that'll be pretty obvious to anybody who's pretty familiar with the market. So they'll question your DCF analysis. But if you discount at a discount rate that's too high, then you offset these mistakes here, and you've come up with the right present value. Which really, in other words, what that means is that the present value is not coming from your DCF analysis, it's coming from the market. It's coming from a direct observation of the markets. In other words, it's basically coming from observing the cap rates. And so you're not really using your DCF, but you're using it as window dressing, right? You're using it as like a pro forma, and you're showing all these beautiful numbers that seem like they're really, scientific and all diligently worked out. This whole 10 years of analysis with all these projected cash flows, the present value, and lo and behold, comes out the present value is the market value, so we can buy the property. So what's wrong? I mean, what's wrong with that if we're getting the right present value anyway? And we're getting the right answer. So what's the harm done? So there is harm done. Oh, this is just a numerical example of what I'm talking about. Here's two cash flow streams. They both start at $1 million. The one on the top is growing at 5%. The one on the bottom is growing at 1%. And suppose they both have a present value of $10 million. In terms of the things you can observe in the market today, they both look identical. $10 million property with $1 million of current income that is generated. But what that means is that the first one is being discounted at a 15% discount rate. The second one is being discounted at an 11% discount rate. So what the point is basically, maybe the reality is the 11% discount rate and the 1% growth. That's the real world. But if you want to, you can make the thing look like a nicer investment. It's growing at 5% and giving you a 15% return, right? You get the same, in terms of anything anybody can observe right now, directly empirically, the $1 million current income, the $10 million market value, it passes muster, right? So, but the point is, it's going to result in people making erroneous decisions. They're going to think they're getting a 15% return. They're going to think they're getting all this growth, and they're not really. And that might cause them to make a bad decision. They might choose to make this investment over another one that would really be better for them had they known the truth. It might also cause them to make a financing mistake. Maybe you could get a mortgage for, let's say, 12%. And if they think they're getting a 15% return on the asset, they might think, oh, borrow money at 12%, invested at 15%, that's a deal, I'll do it. But if really they're getting 11%, and they have to pay 12% for a mortgage, they might not like to do it. Now, the mortgage might be sensible anyway, but it might not be their preference to do that if they had known the truth. So it really does matter. And this is just to show you some empirical evidence that property cash flow really does not grow as fast as inflation on average, usually. And this is some more empirical evidence. This is a classical picture. This is a very widely quoted survey that is done in the industry by PricewaterhouseCoopers. They've been doing this survey for a generation or more, and they always get these kinds of results. They ask people, what are the returns you're expecting in your real estate investments? And they get an answer that is the blue line up here. And then you look historically. And this is from a different source. Okay, so PricewaterhouseCoopers is doing the survey, and they're getting the blue line here. But then you look at another source, and for the same kinds of real estate, you look at what returns they actually provided historically up to that point in time, and that's the purple line here. And this is apples and oranges too, because the purple line is a historical number that goes back to 1977. And during the during the 70s and 80s, so back prior history, there was a lot more inflation than there is now. And these are nominal returns. So those historical returns that are giving you that average include a lot more inflation than what these looking forward returns that are the blue ones that are being surveyed on. So in other words, what you should have is that the purple line should be above the blue line quite a bit, but even more than this. There was a period there when it did cross over, but not by enough. So another way of looking at it is, so what PricewaterhouseCoopers calls the OAR, the overall rate, is the same thing as the cap rate. It's all this terminology, right? So the going in IRR, that's the expected total return. That's this discount rate. That's the R, what I call the R. That should be equal to the cap rate. Remember, the cap rate's defined on the net operating income minus the capital expenditure that you have to pay out. So that gives you an actual cash yield. So that's the Y part, plus realistic growth. That's the G part. So the realistic growth, remember, should be less than inflation because properties depreciate. So what that means is that the brown line, which is the difference between the stated total returns, the IRR, and the cap rate, the stated cap rate, the OAR. The difference there should be basically, it should pretty much be zero. But as you see, although it has been getting better, it's been getting smaller, the gap has been shrinking, but it's still well over 100 basis points. So this is just sort of empirical reality of the kind of typical mistake that I'm talking about here, where we forecast too much cash flow growth and we use too high of a discount rate to offset that to get the present value. So, geez, clock is my enemy. Another thing that people do with DCFs is they do what they call underwriting haircuts. Or they'll do the DCF and you'll point out to them these kinds of mistakes. And they'll say, oh, well, that's the way we underwrite it. So what they mean to say is that they're trying to be conservative. And so they claim that they are, maybe using that high discount rate in order to discount it to a smaller present value to be conservative. The idea with an underwriting haircut is you deliberately use numbers that are biased on the conservative side. This really has a place in the world of originating loans, in the world of making debt investments in real estate. There's you do want to be conservative when you're a debt investor. Debt investors want to have low risk. And they want to be careful about making a loan thinking a property's worth more than it really is. So they do want to kind of err on the side of being conservative. So there's a good reason to do this kind of analysis if you're originating a loan. There's a good reason to do this kind of analysis if you're a bond credit rating agency. But the way this gets used in practice on the equity side, which is the investment side, is it's kind of a license to not use real numbers. Once you're cut free from having to really base your numbers in empirical reality, then it's kind of, you can do whatever you want. And what they end up doing is, maybe they're conservative on the side of the discount rate in terms of using a higher discount rate than is realistic. But they also, like I say, they use a higher growth rate than the cash flows, because that's a number that's a projection in the future anyway. Who's to question it? Who's to know that your number is wrong? Especially when you can hide under the guise of the general conception that rents should grow with inflation. Right? It's hard to argue. People don't tend to argue. If you project your rents to grow at inflation, people don't tend to argue with that. Seems logical. And if you peg inflation at 3%, people don't argue with that either, even though inflation has almost always been a little bit less than 3%. It's a round number, and so people don't argue with always growing the rents at 3%. But that's wrong, right? We've shown you that's one of the main reasons we did module 1, is so you guys could see that the way land values work in cities and the way structure value works in buildings is you typically would expect to get growth in rents less than inflation. And here I'm showing you some empirical evidence that you really do get growth less than inflation. So, it's this is just what goes on in the real world. I'm going to have to quit, right? 5:30. Yeah, so much for my efforts to get through all this stuff. But hopefully you can take these sort of big picture principles, which are really important, and try to see how, when you do the nuts and bolts of the assignments, it comes into play. And remember, when we post the solutions to these things, which it's all been posted, look at the comments that are in the red flags, right? Y'all know what I'm talking about. And yeah, post questions to the forum. And what we'll try to catch up some on Wednesday. Actually, Wednesday on the reputation, I might even do that myself to catch up and to make sure that we're bringing these sort of, this is the forest. I want to bring it down to the trees that are in the forest, which is like the spreadsheets that are on the homework assignments related to this case, the real world case. But I'll tend to talk more about the forest in the class period, and then in recitation we'll go into the so bring your laptops for the recitation, and we'll do that. And I'll be available. Did you find out?
Yeah, 9/4/50.
9/4/58. 4:58.
Yeah.
And what's the time? From 5:30 to 7:30.
I know that.
Yeah. I think we